Hi, my name is Adam West, and I'm with Warren Averett, and I'm here today with Jared Koechner. We're going to talk about financial institutions and the One Big Beautiful Bill and some of the changes that are applicable to financial institutions and also some of their customers. Jared, I know one of the changes we've talked about, and a big one out there, is this interest income exclusion related to agricultural loans. Can you talk a little bit more about that one?
Yeah, Adam. Through the One Big Beautiful Bill, there's a provision in there for the banks to exclude 25% of their interest income related to qualifying loans. These qualifying loans are related to U.S. customers that have real property related to agricultural production. So if the loan fits into this bucket, the bank can classify it as such on their general ledger, and we can take a 25% exclusion on the income related to that loan. These loans would not qualify if they are refinanced. So it has to be a new loan that is originated after that the signing of the bill. So refinances will not qualify. So they're really trying to push additional investment into these areas. And what this is going to it will affect the market for these loans between banks. And we want our banks to be aware of that so that they can be competitive.
And Jared, has there ever been anything like this before?
I have never seen a specific carve out on a loan type. Now, there's certain things that are common in the financial institution industry, like a lot of tax-free bonds and state, city, municipal, those kind of loans. We do from time to time see tax-exempt interest income in different areas, but nothing specific to an industry.
And it'll be interesting to see. I mean, I imagine there will be a lot of guidance that's going to come out addressing this new provision, and we'll just have to see, how that guidance, how it shapes up.
Yeah, exactly. I mean, because in the conversations we've had with our clients, there's always that gray area. Well, where's the line drawn on an agricultural real property? And so hopefully we'll have some guidance on that. And hopefully we're looking for guidance as well on the refinancing. So if we're refinancing a loan, but we add an initial $500,000, can we break out that additional $500,000 and take this exclusion on that increase in the loan balance? So we're definitely hoping for more guidance related to the gray areas here.
Jared, let's talk a little bit about the auto loan interest deduction. I know everyone has heard about this provision at this point, but how does this affect financial institutions? What are some of the things they should be thinking about?
Okay, yeah. So our financial institutions, they need to track these loans that are made, and so that they can report that interest paid to them to their customers, so their customers have a document to claim that interest deduction on their tax return. So and this is for loans that started in 2025, and there's a specific listing of information they need to acquire to include on that document. But at the end of the day, it's an additional reporting requirement that our banks need to be aware of, that if they're doing auto loans, they'll have to send out an equivalent to a 1098. We're still waiting on guidance on what specifically that is. But.
And with the auto loan interest deduction, there are a lot of caveats on what type of loan it qualifies, and it has to be for that vehicle that was purchased has to meet certain requirements. So it'll be interesting to see, do they shift a lot of that burden to financial institutions to determine if it's a qualifying vehicle? Hopefully not, but I think that's something we're keeping a close eye on.
Yeah, definitely, because we want to make sure that we're prepared to, we need to gather all the information that we need to be able to classify these loans and don't miss any reporting requirements related to them.
Another big change out there that affects banks' customers are the changes to the interest expense limitation. So Section 163J, which was a part of the 2017 Tax Cuts and Jobs Act, and that places a limit on the amount of interest expense that a business can deduct. Starting in 2022, that interest limitation got a lot more penal in that it was 30% of EBIT as opposed to 30% of EBITDA. So for the last couple of years, businesses have not been able to add back depreciation and amortization when they're calculating the amount of interest expense they can deduct. Well, for tax years starting after December 31st, 2024, taxpayers are now allowed to use EBITDA and calculate their interest expense limitation off of that. So much welcome change. That should help a lot of bank customers out there be able to deduct more interest expense.
Yep, that's right. And at the end of the day is a favorable provision to allow the customers to deduct more interest expense. So our banks may see an uptick in activity because their customers have a higher threshold or appetite for loans.
Jared, so on the mortgage interest expense deduction, talk a little bit about the changes there related to that.
Yeah. So the change there is that the limitation was made permanent. So there's that $750,000 loan amount limitation that was made permanent so you can only deduct, an individual can only deduct the interest on that initial $750,000 on a personal mortgage.
All right, Jared. So we've talked a lot today about various different provisions. And one of the things we've talked about is we're waiting on guidance related to a lot of these. And the guidance will be forthcoming in the coming weeks and months. And that's something we'll be keeping an eye on. We have a lot of content out on our website that we're keeping up to date. I think we have close to 20 articles, several videos out there. I think what financial institutions should be focused on is, paying attention, working with their tax advisors as new guidance comes out. I think some of the questions that we talked about, how is the auto loan interest going to be reported to borrowers? We're awaiting information related to the agricultural loan interest exclusion.
Yep.
So I think the big call to action for financial institutions right now is be aware of these provisions, number one, but also keeping an eye out for that future guidance that's going to be coming out soon.
That's right. They need to make sure they're keeping track of these loans and the record keeping's there so we can utilize these to their benefit in the future. And we'll continue to maintain or monitor the gray areas and see what additional guidance comes out.
Jared, I've enjoyed going over these provisions today, and we'll keep an eye out for the future guidance.
Yep, I was happy to be here. Thank you.